What is cash management? Cash management can be important for both individuals and companies. In business, it is a key component of a company's financial stability. For individuals, cash is also essential for financial stability while also usually considered as part of a total wealth portfolio. Individuals and businesses have a wide range of offerings available across the financial marketplace to help with all types of cash management needs. Banks are typically a primary financial service provider for the custody of cash assets. There are also many different cash management solutions for individuals and businesses seeking to obtain the best return on cash assets or the most efficient use of cash comprehensively. Understanding cash management. Cash is the primary asset individuals and companies use to pay their obligations on a regular basis. In business, companies have a multitude of cash inflows and outflows that must be prudently managed in order to meet payment obligations, plan for future payments, and maintain adequate business stability. For individuals, maintaining cash balances while also earning a return on idle cash are usually top concerns. In corporate cash management, also often known as treasury management, business managers, corporate treasurers, and chief financial officers are typically the main individuals responsible for overall cash management strategies, cash-related responsibilities, and stability analysis. Many companies may outsource part or all of their cash management responsibilities to different service providers. Regardless, there are several key metrics that are monitored and analyzed by cash management executives on a daily, monthly, quarterly, and annual basis. The cash flow statement is a central component of corporate cash flow management. While it is often transparently reported to stakeholders on a quarterly basis, parts of it are usually maintained and tracked internally on a daily basis. The cash flow statement comprehensively records all of a business's cash flows. It includes cash received from accounts receivable, cash paid for accounts payable, cash paid for investing, and cash paid for financing. The bottom line of the cash flow statement reports how much cash a company has readily available. The cash flow statement. The cash flow statement is broken down into three parts: operating, investing, and financing. The operating portion of cash activities will vary based heavily on net working capital, which is reported on the cash flow statement as a company's current assets minus current liabilities. The other two sections of the cash flow statement are somewhat more straightforward, with cash inflows and outflows pertaining to investing and financing. Internal controls. There are many internal controls used to manage and ensure efficient business cash flows. Some of a company's top cash flow considerations include the average length of account receivables, collection processes, write-offs for uncollected receivables, liquidity and rates of return on cash equivalent investments, credit line management, and available operating cash levels. Working capital. A company's working capital is the result of its current assets minus current liabilities. Working capital balances are an important part of cash flow management because they show the amount of current assets a company has to cover its current liabilities. Companies strive to have current asset balances that exceed current liability balances. In conjunction with internal controls, companies also regularly monitor and analyze liquidity and solvency ratios within cash management. External stakeholders find these ratios important for a variety of analysis purposes as well. The two main liquidity ratios analyzed in conjunction with cash management include the quick ratio and the current ratio. Quick ratio equals cash equivalents plus marketable securities plus accounts receivable. Current liabilities equals cash equivalents plus marketable securities plus accounts receivable. Current liabilities. The current ratio is a little more comprehensive. Current ratio equals current assets, current liabilities. Solvency ratios look at a company's ability to meet all its obligations in the long term. Some of the most popular solvency ratios include debt to equity, debt to assets, cash flow to debt, and the interest coverage ratio.